Hi, my name's Tom Elliott, Director of Beulah Capital. Welcome to the October edition of our Share Market Update. With me here today is Beulah Capital's Chief Investment Officer, Peter Mavromatis. Peter, good afternoon.
Good to be with you, Tom.
So we've just had a very interesting reporting season, a bit of up and down, and of course the share market has been through some turbulence in the past few weeks. What were the main issues to emerge from the reporting season as you saw it?
Well, Tom, it was actually quite a strong reporting season. I think for the most part, expectations were exceeded by company earnings. At a macro level, we got to about 5 or 6% underlying cash profit growth, which is quite strong given the relatively meek nominal GDP growth, which is less than 3.5% over the same time period. Now, if we think about what drove earnings during the year, a lot of that appeared to be really cost out strategy. That's because revenue managed to grow about 4 or 5%, and hence with lower operating expenses and lower financing costs, that drove earnings up to about the 6% growth level.
Tell me, Peter, do you worry though that if most of the profit growth is coming from expense cuts, that obviously there's got to be a limit to that, doesn't there?
There's absolutely a limit to that, and we're predicting that that's going to slow into the fiscal 2015 financial year, I should say. And part of that has got to do with just literally reaching those limits of what you can do. In terms of what companies are then doing with their free cash flow, is they're basically paying that out in dividends. And we saw about 7% dividend per share growth throughout the 2014 financial year, which brings the payout ratio across the market up to about 70%. Now this is quite high, Tom, relative to history, and tells us that it's only really going to be sustainable so long as the big capital expenditure programs, which pretty much ceased earlier or mid last year, basically stay at bay.
Okay, and so what were some of the other things you saw emerge? And so we've got expense cutting, we're seeing increased dividends, reduced capital outlays for businesses. Anything important else to emerge?
Well, I think it's important to say that in the banking sector, which is quite a large part of the ASX, we still have very good doubtful debt provisioning. So the amount of bad and doubtful debt expenses we saw for Commonwealth Bank of Australia, which is Australia's largest bank by capitalisation, was relatively well checked. And that's despite a slowdown in its second half. And despite all that, it still managed to generate cash growth, cash profit growth of 10%.
There's been a lot of talk about inflated house prices, particularly in Sydney, slightly less so in Melbourne. Obviously, the CommBank is the nation's biggest home lender. Do you think there's a potential worry there that maybe the banks could be sitting on a time bomb if indeed we ever have a house price correction here?
I think three factors need to fall into place in order for companies like the CBA and the other banks to get in real strife. One, we need an absolute crunch in the terms of trade. And what that does is basically put a collar, if you like, on domestic spending. Two, we need bigger increases, if you like, or faster increases in the unemployment rate. Now, unemployment rate has been quite buoyant, if I can use that term, in recent times. It's now above 6% compared to in the US, where it's fallen back to that 6% level. If you think about what's happening there, along with the potential for higher interest rates, perhaps over the next 18 to 24 months, then that would need to happen in a way that surprises the markets, I think, for problems to emerge.
Let's just hope that's one of those surprises we don't actually have anytime soon. But it's something that investors have to be aware of. I mean, Australia's big banks are massive in the Australian home loan market. So if you foresee problems in the home loan market, then essentially you're foreseeing some problems in the banks. Now, Peter just mentioned what companies are doing with their free cash flow. We still think the market for takeovers, mergers and acquisitions, if you like, is still particularly strong here in Australia. We've had a couple of years of not too much takeover action. Now we have quite a lot. The Beulah takeover target portfolio has been pretty active as of late. We sold out of Caltex. We bought into Caltex